Hey, what's up guys, Adam here, and first and foremost I'd like to say Happy New Year to you. Hopefully our 2021 is going to be a lot better than our 2020 was. Now in this video, I'm going to be giving you a basic plan towards stock investing here in the UK. I'm going to try and gear it as much to the UK as possible. And this is going to be a plan that you need to consider mainly 5 steps before you even think about creating a stock portfolio account. So without any further ado, let's get right into it. So step 1 is to gain a basic understanding. Now there's a plethora of information out there and trying to consume it all will probably give you analysis paralysis. So I'm going to give you a few key steps in this first step that I think will help bolster out your knowledge and give you the key information that you will need. So the first point I'd say is to try and understand exactly what a share is. Now a share in short is basically part of a company that you can buy into, and by buying into that part of the company you effectively own part of the company. Now you don't really get any say in how the company runs. You don't really get to, of course, talk to any directors of the company, but you actually own a stake within that company. So as that company starts to make money, or if it does really well in the year, then you also reap some of those benefits in terms of its overall profit and return, and therefore you in kind, whether it's a loss or a gain, you will also receive those gains or losses as well. Another area that I would look into is the idea of small, medium and large cap companies. Now in short, a large cap company is a company that has a large amount of capital within it. So of course this is going to cover a lot of your big name companies like Apple, Facebook, Google, anything within the oil space, or any pretty much large company that you've probably heard of will sit within this large cap area. Now on the other end of the scale you have small cap companies. These are companies that maybe have come out of the startup phase and are starting to get on their feet, but they're still fairly volatile in terms of their returns because they're still establishing companies. And in the middle you have the medium cap companies, ones that are sitting comfortably in the middle, tend to do okay some years, tend to do fairly well some years, and fairly poorly on some other years. So they kind of just sit in the middle there. They're trying to get into the big leads with the big boy companies, but they're a lot bigger than the smaller cap companies. So another area I'd recommend that you take a look into is the PE ratio. Now the PE ratio is the share price over the earnings per share, and we tend to use the S&P 500 fund as a benchmark, as its PE ratio is around about 13 to 15 year on year. So anything that falls below that is said to have had a low PE ratio, whereas anything above that will have a much higher PE ratio, and this has a massive effect on the overall share price of the particular stock or the fund. And usually that PE ratio is provided within the documentation of that specific stock or that specific fund. I would also recommend that you understand the difference between an individual stock and a ETF or an index fund. Now I'm going to make an individual video about this, so be sure to stay tuned for that if you want to know more information about individual stocks versus ETFs. But for now, I would say you want to have a clear understanding of the difference between the two and the risk associated with each one. So the last key point within this first step is to keep a tabs on the financial news. Now, no, financial news is not everybody's cup of tea, but that is where you're going to get a lot of information on how the market will perform. So you want to keep it as close on things like how the eco market's doing, how the oil market's doing, what this president's saying and what that prime minister's saying. You want to keep a tabs on this because that has a lot of effect on how the market moves. So step number 2 is to develop an appetite for risk. Now investing in the stock market is always going to have some element of risk. In fact, investing in any market, whether it be in the property market or in the commodities market, there is going to be an element of risk there, and it all depends on how you actually invest. But understand, investing will always put your capital at some sort of risk. It's not like just putting your cash in a bank account where you know when you go back the next day it's still going to be there, it's going to be worth the same amount. When you invest in the stock market, understand you're going to be investing in live active companies, and their share price is changing on a daily basis, which means your money is going to be moving up or down along with the market. Now there are sites out there that allow you to actually assess your appetite for risk, and 2 good examples are CalcXML and InvestRight. Don't worry, they don't ask you a load of questions. It's normally about 5 to 10 questions, and from there, based on those results, they can assess your risk from there, and you can use that as a vehicle to move you forward within your investment goal setting. Now if you're still not satisfied with that as a measure of your risk tolerance, and there's also investing platforms themselves that will analyze your risk. So you will simply deposit your funds there, and it will then get you to do some sort of test to analyze your risk tolerance, and from there it will take those funds and put it into suitable stocks, bonds or shares that are suitable and geared towards your risk tolerance. So moving on now to step number 3. Now step number 3 is to set a goal. Now if you watched my video on how I'm able to save over 50% of my income, I'll link that in the card above. You'll know that I actually mentioned the importance of setting a goal for your future. And this is the same principle that needs to be applied if you're preparing to set up a stocks portfolio. You need to have some sort of goal in mind with this particular portfolio. You don't just want to invest for the sake of it, because without the motivation there of a set goal in place, you will quickly become demotivated. So are you looking to use the stocks portfolio as a secondary retirement fund, maybe in 30 or 40 years down the line? Are you looking to move the stocks portfolio into another asset class, for example, to the property market to buy a buy-to-let property? Are you looking for using the funds to make a major purchase? These are all going to be key questions that you need to ask yourself, and they're going to have a massive impact on how much you actually invest per month, and particularly what you actually invest into. So having these questions in mind right now are going to be key to setting your SMART goals. So step number 4 is to choose a platform. Now there's several platforms that you can choose from. It really depends what you're most comfortable using. In this plan, I'm going to give you some key examples that I think will steer you in the right direction, and they're going to be mainly based in the UK, since that is where I am based. So if you're someone that spends a lot of time on their smartphone, maybe you do a lot of your social engagement or a lot of your work on your smartphone, then maybe you'll prefer a more mobile-centric investing platform. And some of these examples are Trading 212, Freetrade, eToro. These are more mobile-friendly investing platforms. And the good thing about Trading 212 and Freetrade is that they both have zero trading and commission fees. Really attractable in order to keep your portfolio fees down. Or if you're someone who prefers to do most of your work at the desktop, maybe you have more of a set and forget kind of mindset, or you're not really interested in picking individual stocks, then maybe you can consider Vanguard. Now, Vanguard is a major platform both here in the UK and the US. It has a large array of different funds. It doesn't have any individual stocks, but it has a lot of ETF funds available, as well as bonds. So if you're someone that wants to prefer to just pretty much invest your money on a monthly basis and just leave it, forget about it, then Vanguard is not only a big name company, but it is a really good investing platform with really low fees. Or if you're somebody who is fairly old school and likes to pick up the phone and talk to somebody if they know they've got any issues, or you want more of that one-to-one interaction like you'd get at a bank, then I would recommend that you go with someone like AJ Bell or Hargreaves Lansdown. Now, they don't really have the biggest options in terms of ETFs and stocks, and their trading fees are quite high compared to other investment platforms that I've listed right here, but they are big companies here in the UK with a really good reputation. My lifetime ISA is actually with Hargreaves Lansdown, and they've been a really fantastic company in terms of their customer service. Now, if you'd like to see me do a video on opening up an investment account, then let me know in the comment section down below. So step number 5 is to make regular contributions. Now, it's no good just to simply put in a small lump sum into the portfolio and expect that amount to grow to the moon. That's not how it works. You need to be able to make regular contributions to your portfolio month on month, or even week on week if you want to do it that way. And that's how you're going to really get the benefit and the growth of compound interest. If you watched my How I Save Over 50% of My Income video, you'll know that one of the key points that I mentioned was paying yourself first. This is going to be a prime example of where you can pay yourself first. So you can set up a direct debit on payday to make sure the amount you want to move over into your stocks portfolio takes place on payday. That way you haven't got to think about it later on in the month. You already know it's moved over. And that way you can guarantee then you are actually building up your stocks portfolio. So anyway guys, that has been the video. Now, it's really important that you actually do go through these 5 steps before you just simply open up an account. You don't just want to go blindly and open up an account and you're not quite sure what you're doing. You just go and buy some random stocks here and there and end up losing money because you didn't do your prior research. So make sure you actually look, have a plan in place, know exactly what you want to do with that stocks portfolio before you open up the account. So if you like this video, make sure you give it a like down below. If you want to see more videos like this on investing, personal finance, business and videography, then this is the channel for it. So make sure you hit the subscribe button down below. And anyway guys, this has been Adam here. Thank you for watching. Take care. And of course, I'll see you in the next video. Bye for now.